The International Monetary Fund has told the Bank of Jamaica to let the Jamaican dollar move more freely. The IMF says the central bank is intervening too often in the currency market. By selling or buying US dollars, the Bank of Jamaica has been keeping the exchange rate more stable than it would naturally be. The IMF thinks that this frequent intervention can stop the economy from adjusting on its own. They want the currency to reflect real supply and demand. Currencies are managed in different ways around the world. Some countries have a fixed exchange rate. That means their central bank ties the value of their money to another currency, usually the US dollar. For example, Barbados pegs its dollar at about 2 Barbados dollars for every 1 US dollar, and it stays at that rate unless the government changes the peg. This system gives stability but removes flexibility. On the other side are floating exchange rates. In these systems, the currency's value is decided by the market, by supply and demand of foreign exchange. The US dollar, the euro, and the Japanese yen are examples of floating currencies. The value can change every day depending on trade, investment, or global events, and the central bank usually doesn't step in. Jamaica officially has a floating exchange rate. The value of the Jamaican dollar is supposed to be set by the market, not by the government. But in practice, the Bank of Jamaica intervenes often by buying or selling US dollars. This keeps the Jamaican dollar from moving too wildly. It doesn't act like a fixed peg, but it does mean the currency is more managed than a pure float. So Jamaica sits somewhere in between, officially floating, but in reality, it behaves more like a managed floating currency. The Bank of Jamaica manages the Jamaican dollar to protect people and businesses. If the dollar drops too quickly, it can make imported goods like fuel and food more expensive. That pushes prices up across the country. The central bank steps in to slow down big swings. When there is too much demand for US dollars, they sell from their reserves. When there is too much supply, they buy dollars. This keeps the currency from jumping up and down too fast. Jamaica has a long history of inflation problems. A weaker dollar means higher costs for basic goods. The Bank of Jamaica uses its interventions to prevent sudden price increases. It wants to keep inflation low and predictable. People and businesses can plan better when prices are stable. This is why the BOJ continues to step in, even if the IMF says it should step back. Another reason for intervention is investor confidence. Sudden changes in the currency can scare investors. It can make borrowing money from abroad more expensive. By keeping the exchange rate steady, the BOJ signals that Jamaica is a safe place for business. This helps maintain investment and economic growth. The strength of Jamaica's reserves is important. As of August 2025, the Bank of Jamaica had about $6.15 billion US dollars in net international reserves. Gross reserves were around $6.2 billion. These are record highs. They cover many months of imports and give the central bank enough resources to act if the market becomes unstable. Governor Richard Biles has said the reserves are healthy and strong, built without borrowed money. The IMF is not saying Jamaica cannot use its reserves. It is saying that reserves should not be used every day. They should be kept for real problems, like sudden spikes in oil prices, capital leaving the country, or a crisis in tourism. For everyday fluctuations, the IMF wants the central bank to let the dollar find its natural value. If the BOJ reduces interventions, the Jamaican dollar may move more often. It could lose value faster at times. This would make imports more expensive and could push up inflation in the short term. But there are benefits too. Exporters could get more profit when the dollar is weaker. Tourism could also gain because visitors get more value for their money. The economy would adjust naturally to real market conditions. If the BOJ keeps intervening, the exchange rate will stay more stable. Prices for households and businesses will change more slowly. Inflation expectations would remain anchored. The reserves would be used more often to maintain stability. With more than $6 billion US dollars, Jamaica has the capacity to manage either way. The choice is about strategy, not strength. Both sides have points. The IMF wants a more flexible currency that forces the economy to adjust and protects reserves for emergencies. It gives investors and businesses clearer signals. The BOJ wants stability. Rapid changes in the currency hit consumers quickly. Fuel, food, and electricity costs would rise if the dollar moves too fast. Inflation could increase, and credibility built over years could be at risk. For people in Jamaica, this affects daily life. If the currency is allowed to move freely, prices for imports will rise faster. Households might need to budget more carefully. Businesses will need to plan for higher costs or adjust their operations. If the BOJ continues managing the exchange rate, changes will be slower, giving people more predictability. Looking ahead, the debate will continue. The IMF will push for less intervention, while the BOJ will focus on stability. Investors, businesses, and households will all watch how the central bank acts. Key things to watch include reserve levels, inflation data, and official statements from the BOJ and the IMF. These will show whether the currency is moving more freely or staying managed. The main point is that Jamaica now has choices. Reserves are at record highs. The economy is stronger than in past decades. The country can decide how much flexibility to allow and how much stability to protect. The IMF wants the reserves saved for big problems. The BOJ wants to use them to manage the daily market. Both are trying to protect Jamaica, just in different ways. In the short term, letting the dollar float could cause prices to rise quickly. Fuel and food costs would be felt in every household. Businesses importing goods may face higher expenses, but exporters would benefit, and tourism could improve. Over time, the economy could become more resilient and better aligned with real supply and demand. Maintaining stability has its own benefits. People know what to expect. Businesses can plan. Inflation is easier to manage. The central bank can use its reserves to prevent sudden shocks. Both approaches have trade-offs, and Jamaica has the resources to manage either way. The IMF wants a more flexible currency to strengthen the economy over time. The BOJ wants a managed currency to protect consumers and maintain trust. Either choice will shape the value of the Jamaican dollar and the cost of living for Jamaicans. What is clear is that Jamaica is not weak. It has built reserves, experience, and systems that allow it to make its own choices. The coming months will show how the BOJ responds. Will it step back and let the currency move more freely, or will it continue managing your rate closely? Either path will have effects on prices, businesses, and investment. Jamaicans should pay attention to reserve reports, inflation data, and BOJ statements to understand which approach the central bank is taking. Jamaica's record reserves give it a strong foundation. The IMF wants them to be a safety net, not a daily tool. The BOJ sees them as a tool to maintain stability. The debate is about balance. Stability protects people now. Flexibility builds resilience for the future. Jamaica has the strength to choose the path that best serves the country.